Hi guys, welcome back to the channel. My name is Dave, and today I want to talk about QQQ from Invesco, also known as the Qs. This is our fifth largest ETF based off of AUM, and it's been around a while. If you've been buying shares recently, you're doing quite well. You should be happy because over the last year, it's up over 50%. People are very excited. For the last 10 years, it's up over 425%. Outstanding. But there was a period, if you went all the way back to 2000, from 2000 to 2016, if you invested $100, 16 years later, they would have handed you back $100. So there are times when it performs really well, times when it takes a break. So let's take a look at the Qs. It's so important to us. A great one to have in the utility belt. If that is what you're looking for, please stick around. Whoop. QQQ, which is based off the NASDAQ 100 index, has been on a great run. So if you bought shares back in 2023, you should be pretty happy here in 2024 as it continues to go higher and higher. So going back even 10 years, as I mentioned, it has a total return of 425%. Just a great investment for those that have stayed with it. Now, for a long period of time, QQQ did nothing like I was talking about. If you purchased shares on March 20th of 2000, you could have paid around $117 for those shares. If that's all you did, as of August 2016, you would have finally broken even. 16 years of nothing. You made a bad loan, essentially, right? And if you compare that to the S&P 500, it underperformed during this period as well. So tech or innovation is not always the leader. So what does this tell me? Well, first, it happened once and it could happen again, that long dry period. Second, it takes time, but historically, the stock market goes up and to the right. You got to have patience. And third, if you are a long-term dollar cost averaging investor, as we all should be, and you stay invested, you would have killed it in QQQ, including that 16-year period. I mean, you would have been buying during all these low periods, building a position that would be worth a bunch at this point. You know, dollar cost averaging is essentially investing magic, the simplest version of investing magic. So what exactly is QQQ? Well, we know it's the fifth largest ETF based off of AUM, only behind four S&P 500 ETFs. Well, let's call it three, plus one other VTI, which is essentially an S&P 500 ETF with a couple other bolt-ons. They perform about exactly the same. But QQQ is an ETF based on the NASDAQ 100, which is made up of the top 100 largest NASDAQ stocks. And it's important to understand there are no financial stocks in the NASDAQ 100. They rebalance the index quarterly, and they also have a special rebalancing in case certain components become too large within the index. And that's actually happened previously in 2023 with some of the tech stocks that took off in the index. So be aware that can happen. And they also reconstitute the index in December and they kick out the riffraff. You know, that's one of the reasons it's sometimes difficult to just say, I'm going to beat this index, because every year they're just sweeping aside the poor performers and they're bringing in the new hot stocks. So it's one of the reasons that sometimes it's great just to simply invest into something like QQQ or an S&P 500 index ETF. But according to Invesco and their advertising, QQQ is an agent of innovation. And you too can become an agent of innovation by investing in QQQ. That always gets me to smile a little bit. Now, it is mostly tech stocks, but they shouldn't sell themselves short either, because it also has some nice diversity in things like consumer cyclical stocks, healthcare, and industrials, which means you get stocks like Pepsi in this innovative fund. Now, I don't think of Pepsi much as an innovator, but they did come out with s'mores Pepsi, so how can you argue with that? Anyway, likewise, you're also going to be an owner of Starbucks with an investment in QQQ, which means this is somehow innovative coffee, a spooky coffee, I suppose. Anyway, it is primarily those big tech stocks we know and love. And if we look at their top holdings, we will see, all leading the charge, Microsoft, Apple, Amazon, Nvidia, Broadcom, Meta, Tesla, Google, both classes, Costco, Adobe, AMD, so forth and so on, down to Pepsi and those innovative Pepsi products we talked about. Well, let's back up and let's take a closer look here. Let's talk about Nvidia for a second. We have to talk about Nvidia, right? Are there any happy shareholders out there? I hope so. And I don't want to get sidetracked, but just look at this chart from Y Charts on the historical PE of Nvidia. Now, this is the PE based on the trailing 12 months, but each earnings report, just look at the PE getting chopped down, right? Now, in my opinion, we should be looking forward at the forward PE, which is what you will find on Seeking Alpha on their cover page. And by the way, I'm a Seeking Alpha affiliate. If you want to sign up, there are affiliate links down below. But for those wondering, PE tells us what we currently have to pay for each dollar of earnings. So I think it's best to look forward because we want to pay for future earnings, not what happened in the past. And I've had this discussion with some other people too. And for NVIDIA, this last earnings report took the forward PE from over 50 down to 32. So it's not looking too expensive now, right? Really impressive. And as an owner of QQQ, you're going to get some nice exposure to moves like this in a particular stock like NVIDIA. Bottom line, in my opinion, the Qs are a great way to simply invest in the stock market. You can keep quite simple. Just buy some shares and hold on to them. But if you bought shares, sold puts, bought calls, or even sold covered calls on a long position, you likely did well in 2023 with QQQ. Now, I routinely buy shares and I just own it, but I also love it for options. And that is probably the biggest reason I use it in my portfolio. It has lots of option volume, which means it is easy to jump in and out of contracts, and that bid and ask spreads are nice and tight. And I'm sure that I have had an open option position with QQQ every single week of 2023 and into 2024. And I think I batted 100%, honestly. And those returns were nice. But simply owning the shares would have been provided a better return in 2023. So I overcomplicated it when I was doing these option trades, especially with it up over 50% over the last year. But for those curious about Willing QQ, I go into more detail in this video about how I like to do that. But again, keep it simple and just buy QQQ. Now, there are plenty of alternatives to QQQ, and I would say for those that don't really care about options, it's probably not the best one for you. You can still get exposure to all these great innovative tech stocks and not pay that hefty price tag of 0.2%, which is the expense ratio for QQQ. It's fairly high, and when you compare it to some of the other tech ETFs out there, such as VUG from Vanguard, which is 1/5, that expense ratio is sitting at 0.04%, well, you might consider some of these other plays, and you can mix in some of these other things that will give you exposure to your Pepsi and your Starbucks. But some others that are tech focused are XLK, VUG as mentioned, or VGT. And there are plenty of options to get exposure to the NASDAQ 100, but QQQ is the big boy. You can also look at QQQM, which is also from Invesco, but offers the index, same thing at 0.15%. That's a 25% discount for the same exact thing. So if no options are in your future, buy the M version, QQQM. And there's also QQQE, which is the equal weight version. So if you've looked at RSP before versus SPYI, I have a video on that. I'll link it up above. Maybe you go with the equal weight version. That's QQQE. So check that one out. So find your favorite flavor and start buying. It's probably not going to be the s'mores version, but you'll find something. And it might take 16 years, but the payoff is likely going to be there in the long run based on past history. So for me personally, I like to use QQQ as my utility belt tech sector ETF. So I do buy and accumulate shares over time, and it's kind of littered throughout several portfolios. I slowly build up a position, but I also like to use it to sell puts against or put credit spreads and try to add some income that way. If I do get something assigned, it's okay because I can wheel those shares or I can hold on to them for a while and then eventually sell a call. It just depends on my view at that moment, but it's a great thing to be exposed to because it is so flexible, right? You don't necessarily have that flexibility with things like XLK, VUG, or VGT that we talked about as alternatives, or that QQQM. All of those would be products that I would probably just buy and add and keep investing. Very simple. But with QQQ, again, we have that flexibility. So I like that. And that's worth a little bit more on the expense ratio side for me. So a lot of my shares go into QQQ and hopefully some income along the way. Now, if you have any questions on any of this, please just ask down below. I appreciate you watching. If you like this type of thing, please like and subscribe. And we'll see you next time. Take care.